In 1994, the global bond market collapsed so violently that traders still call it the Great Bond Massacre. Yields exploded upward, wiping out trillions in weeks and triggering a chain reaction that almost broke the modern financial system. Today, yields are rising even faster, but almost nobody is talking about it. Most people don't know this, but the bond market is 20 times larger than the stock market. When it cracks, everything cracks. And right now, something is happening behind the scenes that looks eerily similar to 1994. Except the stakes are far higher. Governments are hiding the true scale of the rout, central banks are quietly panicking, and what happens next will shock most people. It starts quietly, it always does. A number on a chart moves a little too fast. A line that's supposed to drift suddenly spikes. And the people who truly understand what they're seeing feel their stomachs drop. Because when bond yields surge at the speed we witnessed in early 2025, it is not a market adjusting. It is a system breaking. Most people don't watch bond yields, they watch the stock market. They watch crypto, they watch housing. But professionals, the people who run sovereign wealth funds, pension systems, and megabanks, they know the truth. The bond market is the spine of the global economy. And in the first weeks of 2025, that spine bent far beyond its normal limits. Long-term yields jumped nearly 10% in a matter of weeks. That kind of move shouldn't happen in a stable financial system. Statistically, it's the type of event you'd expect once every few centuries. And yet here it was, unfolding in real time. The charts looked wrong. The models failed to explain it. And traders described the movement not as volatility, but as violence. But if you were watching the financial news, you'd never know it. They called it market repositioning. They called it technical readjustment. They called it everything except the one word that actually describes what happened: rout. Because here's the hidden truth. When yields explode upward, it means prices are collapsing. Bond prices fall when yields rise, and the speed of the rise tells you exactly what's happening behind the curtain. Yields don't surge like that unless someone is being forced to sell, hard, fast, and at any price. Someone large was cornered. Someone was liquidating. This wasn't speculation. The data was right there in plain sight: massive outflows from long-duration funds, emergency collateral calls, unusual spikes in repo markets. These are not signs of a healthy financial environment. They are symptoms of a system straining under pressure it can't release. And yet, strangely, no official warnings. No emergency announcements, no flashing red lights. Just silence. And spin. Because this is the part the public never sees. The narrative management. When the bond market starts to slip, governments, central banks, and major institutions move quickly. Not to fix the problem, but to control the story. Bond market panic is dangerous because it spreads fast. It triggers margin calls. It creates liquidity shocks. And most importantly, it exposes the fragility of the entire monetary structure. So instead of acknowledging the rout, the system did what it always does. It minimized, it redirected. It buried the truth under jargon and optimism. But the traders knew, the insiders knew. The people who actually had to meet collateral requirements knew. Because a surge this violent isn't caused by repositioning. It's caused by someone drowning, someone being margin called into oblivion. Someone dumping bonds into a shrinking pool of buyers, and once that selling begins, it is almost impossible to stop. The world's largest market, bigger than stocks, bigger than real estate, bigger than currencies, was sending a signal. The foundation is cracking, the pressure is building. The system is creaking under weight it was never built to sustain. Most people imagine financial collapses as dramatic crashes, flashing screens, sirens, chaos. But that's not how they begin. They begin with quiet distortions, sudden anomalies, strange movements that don't fit historical behavior. They begin exactly like this, because when bond yields surge at a speed the models say is never supposed to happen, it tells you one thing: the safe asset of the world is no longer safe. And when the safest asset becomes volatile, everything else, every mortgage, every corporate loan, every valuation, begins to shake. This was not the peak of the story. It wasn't even the middle. It was the opening tremor, the first crack in a much larger, much older fault line. And to understand why this moment feels so eerily familiar and so uniquely dangerous, we need to go back to the last time the world witnessed a surge like this. A surge that reshaped economies, toppled funds, and nearly broke the global financial order. Because we've been here once before. And that chapter of history is about to repeat itself. Only this time, the consequences will be far greater. In financial history, certain years become warnings. 1929, 1971, 2008. And for the bond market, that year is 1994, the last time yields spiked with the same violence we are seeing today. To understand 2025, you have to walk back into that moment, because the echoes aren't just similar, they're almost identical. Except this time, the system is far more fragile. In 1994, almost no one saw it coming. The Federal Reserve, under Alan Greenspan, shocked the world by raising interest rates far faster than expected. It wasn't a minor adjustment, it was a jolt. A sudden tightening that detonated across global debt markets like a financial earthquake. Bond prices collapsed. Long-term positions that couldn't fail, failed instantly. Trillions in value evaporated. Most people don't know this, but some of the most sophisticated hedge funds in the world were wiped out in weeks. Banks scrambled to rebalance, risk models broke, and the devastation spilled out of Wall Street and across borders. Mexico spiraled into a full-blown crisis. International lenders froze. Panic rippled through Europe. It was, in every way, a global margin call. That was with a world that had only a fraction of today's leverage. And this is where the story turns. Because if 1994 was a crisis born from rate shocks, 2025 is a crisis born from structural overload. Back then, governments carried modest deficits. Debt to GDP ratios were manageable. Borrowing was disciplined. The global financial system had buffers, real buffers, that could absorb sudden shocks. Even the Federal Reserve had what policymakers call policy space, the ability to cut or raise rates without destroying the foundation of the system. But today, none of that exists. The world now sits on top of the largest debt pile in human history. Government deficits are no longer cyclical, they're permanent. Corporations run on borrowed oxygen, consumers are loaded with liabilities, and financial institutions are far more interconnected, far more leveraged, and far more exposed to rate volatility than they were 30 years ago. In 1994, the system was stressed. In 2025, the system is stretched to the breaking point. What makes this comparison even more disturbing is how little room central banks have to maneuver. In the 90s, inflation wasn't the monster it is today. If markets cracked, the Fed could ease. If credit tightened, they could cut. But in 2025, inflation still lingers like a smoldering fire. The Fed can't cut rates without risking another surge in prices. They can't raise them without detonating even more debt. They are trapped, a position policymakers in 1994 simply were not in. And the consequences of this trap are cascading. When yields rise today, the government instantly feels the pain. Every percentage point increase adds hundreds of billions in extra annual interest costs. Private borrowers feel it. Corporations feel it. Global markets feel it. Because the debt machine is so oversized, even a small move becomes seismic. Which brings us back to the parallel. In 1994, yields surged quickly, but the system survived because its structural supports held. Today, those supports aren't just weakened, they're hollow. Debt is historic, deficits are structural, leverage is systemic, and liquidity is thin. This time, the same shock is hitting a world that can't absorb it. But here's the truly unsettling part. Most investors today don't remember 1994. They didn't trade through it. They never studied it. Many weren't even born. And so the lessons that should be obvious, the warnings that should be respected, are being ignored. They see the bond rout of 2025 as an anomaly, a temporary repricing, not realizing they're watching the early stages of a cycle that has repeated for centuries. The parallels are striking. Rapid tightening, sudden yield spikes, violent repricing. But the divergences? They're downright terrifying. Because the one tool that stabilized 1994, central bank flexibility, no longer exists. We are living through the same script, with the safety net removed. And this brings us to the next question. The one no one in the financial media wants to touch. If the system is this fragile, why doesn't it look like a crisis? Why isn't the panic visible? And who is keeping the public calm while the foundations crack beneath them? The answer is simple and unnerving. Because unlike 1994, today's system has learned how to mask a bond rout. The strange thing about financial crises is that they don't look like crises when they begin. They rarely start with panic, chaos, or headlines. Instead, they start with silence, an unsettling calm that feels almost scripted. Bond yields explode upward, money flees, liquidity thins. And yet the public hears nothing. Because in modern finance, stress isn't revealed. It's managed. And in 2025, that management has evolved into something far more sophisticated and far more dangerous than anything we saw in 1994. The first masking mechanism is government issuance itself. When long-term yields spike, the very yields that determine a nation's true cost of borrowing, governments quietly shift their debt sales to short-term Treasury bills. These bills have lower rates, shorter maturities, and fewer eyes watching them. It's like a family hiding credit card debt by taking out payday loans, cheaper today, catastrophic tomorrow. But to the public, it looks like stability. Long-term rates barely moved, they're told. In reality, the government simply stopped issuing long-term bonds, so markets couldn't price the real damage. Then there are the central banks, masters of the subtle disguise. Whenever liquidity dries up, they announce temporary liquidity tools, seasonal adjustments, or technical operations. These sound harmless, bureaucratic, boring by design. But behind the language lies emergency intervention. Repo windows quietly expand. Swap lines open overnight. Balance sheets swell by billions under labels no average person will ever read. And every time officials are questioned, they repeat the same line. This is not QE, but the effect is the same. The system is getting oxygen it shouldn't need. Pension funds play their role too, and their role is equally invisible. These institutions cannot panic publicly. Their entire existence depends on appearing stable. So when bond prices collapse, pensions silently rebalance. They sell equities to buy cheaper bonds. They take losses so quietly the public never notices. They shuffle assets behind the scenes, absorbing impact the way a building's support beams absorb earthquake tremors, but beams only bend so far before they snap. Meanwhile, the media, intentionally or not, completes the illusion. They focus on the stock market, because the stock market is where the narrative is clean, predictable, easy to digest. Tech stocks rally. Investors rotate into safety. Markets rebalance. But bonds. The bond market is too large, too complex, too revealing. A collapsing bond market doesn't just affect investors, it affects governments. It exposes debt addiction. It raises uncomfortable questions about sustainability. So instead of explaining the danger, media outlets divert attention away from the one market that determines the fate of every other. But the most powerful masking mechanism of all, and the least understood, is the derivatives market. Most people don't know this, but institutions use enormous, layered, complex derivatives to artificially smooth out volatility. Options, swaps, futures. These contracts allow losses to be deferred, hedged, reshaped, and buried under temporary protections. To the outside world, portfolios look stable, risk seems low, volatility appears controlled. It's a financial version of cosmetic surgery. The structure may be collapsing, but the surface looks flawless. The problem? Every derivative has an expiration date. Hedges don't last forever. And when the underlying asset, in this case, long-term bonds, falls too far, too fast, those hedges stop working. Institutions get margin called, protection unwinds, and losses accelerate instantly. This is exactly what began happening in early 2025. Suddenly, the quiet mechanisms weren't enough. Central bank tools began losing effectiveness. Government issuance tricks couldn't hide the surge in costs. Pension funds ran out of room to rebalance, and derivative hedges began collapsing under their own weight. The mask started slipping. Behind it, a very different picture appeared: forced selling, margin calls, liquidity shortages, the early signatures of a full-scale bond panic. But the scariest part isn't what the masking mechanisms hide. It's what they create. Because every trick the system uses to smooth volatility today simply stores more pressure for tomorrow. Every hedge that delays losses magnifies future losses. Every central bank tool postpones liquidity stress but deepens long-term fragility. Every media diversion blinds the public to a much larger storm building in the background. The masking mechanisms don't prevent crises, they concentrate them. They make the eventual break sharper, faster, more violent. And now that the hedges are failing, now that liquidity windows are widening, now that governments are sprinting away from long-term issuance, the truth is becoming impossible to hide. The bond rout isn't a technical issue, it's a systemic rupture. But to understand why these mechanisms are failing, why no amount of narrative management can stop what's unfolding, you have to look deeper into the structural mathematics underlying the entire bond market. Because the next layer of this story isn't about psychology. It's about math. And the math can no longer be ignored. There's a moment in every financial crisis when emotion becomes irrelevant. When the fear, the speculation, the narratives all give way to something colder and far more unforgiving: math. And the math behind the 2025 bond collapse isn't just alarming, it's terminal. Because bond markets don't care about politics, they don't care about narratives, they don't care about soft landings or technical adjustments. Bond markets respond to one thing, and one thing only: numerical reality. And that reality is breaking. For years, governments around the world borrowed as if rates would stay near zero forever. Debt piles rose exponentially. Deficits ballooned. Refinancing schedules condensed. Politicians assumed the system would bend indefinitely, that the cost of borrowing would remain cheap enough to sustain the illusion of control. But interest rates don't move exponentially, they move linearly. And when a system built on exponential debt meets even a linear rise in rates, the math collapses like a bridge under too much weight. In 2025, the numbers tell the story more brutally than any crisis headline. A 1% rise in yields now adds tens of billions to annual government interest payments. A 5% rise, hundreds of billions. A 10% surge in long-term yields, the very surge we just witnessed, creates cost increases so enormous they approach wartime financing levels. Except this time, there is no war. Just the arithmetic of a government that has borrowed itself into a corner. Most people don't know that governments don't repay old debt with savings. They roll it over, issuing new bonds to pay off the old ones. When yields rise, that rollover becomes exponentially more expensive. Every auction becomes a deeper cut, every maturity date becomes a threat, and every new issuance drags the deficit further underwater. This is the doom loop. Higher yields, higher interest costs, higher deficits, more bond issuance, even higher yields, even higher interest costs. A cycle with no escape hatch. This loop isn't theoretical, it has destroyed sovereign bond markets throughout history. Argentina, Greece, Weimar Germany, Britain in the 1970s, even the Roman Empire, in its final century, collapsed under the weight of compounding fiscal obligations. When debt outruns income, and financing costs outrun revenue, the downfall isn't ideological, it's mathematical. And today, the world's largest economies are entering this same loop. The United States, the Eurozone, Japan, all are approaching a point where the interest on their debt grows faster than the economy itself. That is the mathematical death zone. No amount of productivity, no amount of taxation, no amount of growth policy can offset rates rising faster than GDP. Once inside that zone, governments start making desperate choices. They freeze budgets, they raid pension funds, they slash essential services, they monetize debt, they print, suppress, intervene, grasping for any lever that buys them a few more months of stability. This is where policy stops being strategic and begins being survival-based. It's the point where governments become unwilling participants in a crisis they can no longer steer. The point where central banks lose control of the yield curve. The point where markets begin pricing risk on their own terms, not the terms officials wish existed. And we are entering that moment now. The math has stopped working. The equations no longer balance. And when the math fails, history shows there is only one direction left for policymakers: intervention at any cost. That cost, however, is about to fall on someone, on institutions, on nations, on ordinary people who never saw the numbers behind the system's polished facade. Because when a system this large begins breaking, the pressure must go somewhere. Someone must take the loss. Someone must be sacrificed to stabilize the equation. And the first clue to who that someone is comes from one question no one has fully answered. If yields are rising this violently, who is selling, who is dumping, and why now? Because the next phase of the story reveals exactly where the pain is accumulating, and who is already being forced into liquidation. Every market crash has a moment when the truth slips through. A glimpse behind the curtain that reveals who is actually bleeding. And in the 2025 bond rout, that moment came when yields spiked so fast, so violently, that only one explanation remained. Someone enormous is dumping U.S. Treasuries, not trimming, not hedging, dumping. And once you start asking who, the answers get unsettling very quickly. Because the first suspects are the foreign giants, China and Japan. For years, both nations were among the largest holders of U.S. debt. They were the stabilizers, the backstops, the buyers of last resort. But that era is over. Geopolitics, aging populations, and shrinking trade surpluses have forced both countries to pull back. China has been reducing U.S. bond exposure aggressively since the mid-2010s. Japan, once the largest foreign holder, now sells to defend its own collapsing currency. These countries aren't supporting the treasury market anymore. They're unwinding from it. But even if every foreign holder sold, it wouldn't explain the speed of the rout. Something bigger is happening. Look at domestic banks. They're sitting on hundreds of billions in unrealized losses after 2 years of rising rates. Their bond portfolios, once considered risk-free, are now underwater. Banks can pretend those losses don't exist as long as they never sell. But in a stressed liquidity environment, pretending isn't an option. When depositors pull cash, when funding costs rise, when regulations tighten, banks are forced to raise liquidity. And that liquidity often comes from the only place they can turn quickly, the bond market. Then there are the pension funds, the silent whales of the financial system. These institutions manage trillions, and they were hit hard by the rapid yield spike. As bond prices fell, their liabilities soared. To stay solvent on paper, many had to rebalance in the shadows, selling what they could, buying what they must, quietly absorbing losses that they cannot admit publicly. When pensions sell, they don't nibble. They unload entire blocks. But the most dangerous sellers, the ones who accelerate a rout into a collapse, are the hedge funds caught in wrong-way trades. Many hedge funds bet on falling yields in late 2024, expecting recession. Instead, yields exploded upward, and leveraged funds don't have the luxury of waiting. They get margin called. They get liquidated. When their trades blow up, brokers seize collateral and dump it onto the market indiscriminately. This creates a cascade. Each forced sale pushes yields higher, which triggers more margin calls, which forces more selling. A self-feeding cycle of destruction. Yet even all of that doesn't capture the full picture. Because while these players are selling, the U.S. government itself is flooding the market with new supply. This is the hidden truth, buried in Treasury reports. The U.S. must refinance over $9 trillion in maturing debt within the next year. That's refinancing, not counting new deficits. Every rollover requires new buyers, every auction increases supply, and every dollar of new supply pushes yields higher unless a larger pool of buyers steps in. But those buyers aren't stepping in. When you combine forced sellers with record government issuance, only one outcome is mathematically possible: collapsing bond prices. And here's the most important psychological dynamic. Financial markets follow hierarchy. When the whales sell, the minnows panic. Smaller funds, family offices, retail bondholders, once they see yields spiking and prices cratering, they follow the leaders. Not because they understand the underlying math, but because fear is contagious. This is how liquidation spirals begin. A handful of distressed sellers trigger a wave. The wave triggers more selling, the selling becomes systemic. And before the public recognizes what's happening, the rout is already too large to contain. But the question no one in Washington wants to answer is this: what does a world look like when every major class of buyer is stepping away from the Treasury market? When the single most important financial asset on earth loses its strongest supporters? Because when the bond market cracks, it doesn't just destroy portfolios. It forces the entire global financial system to reprice itself, and that repricing is what comes next. When the bond market shifts, the world doesn't react. It recalculates. Quietly, brutally, mechanically. And the recalculation now underway is so large, so sweeping, that most people won't understand what happened until months after the damage is locked in. Because bond yields aren't just numbers, they're the gravity of the financial universe. And when gravity increases, everything becomes heavier. Every mortgage payment, every corporate loan, every construction project, every government budget, every pension liability, every investment model, all of them hinge on yields. So when yields suddenly surge 10% in weeks, a move so violent it rewrites financial models in real time, the system doesn't wobble. It reprices, and the repricing has already begun. The first shock hits households. Mortgage rates jump, buyers evaporate, sellers panic. Real estate transactions freeze. A home listed at $500,000 suddenly requires $800 more per month to finance. Most families don't think in purchase price. They think in monthly payment. And when that payment spikes overnight, demand dies instantly. This is why housing markets in 2025 began behaving eerily like they did in the late 70s. Rising rates crushed affordability so violently that transactions simply stopped. Prices don't crash at first, they stall. But stalling is the first stage of collapse. Then the shock hits corporations. Companies that borrowed heavily during the zero-rate era now face refinancing at triple, sometimes quadruple, the cost. Suddenly, the math behind their business models fails. Projects get cancelled, debt-fueled expansions unwind, stock buybacks shrink, and CFOs, the real risk managers of corporate America, deliver the same chilling message to their boards. We need to cut. And that means layoffs. Governments aren't spared either. They face the most brutal math of all. Rising yields instantly inflate interest costs on national debt. Infrastructure plans get shelved, public spending shrinks, social programs face cuts. Politicians start using phrases like fiscal responsibility, not because they believe in it, but because the math forces it. The silent destruction of purchasing power begins here. Schools see fewer funds. Cities delay repairs. States halt hiring. Federal budgets start shifting money away from services and toward interest payments, paying for the past instead of investing in the future. This is how societies age. Not with explosions, but with quiet erosion. Banks tighten lending, not because they want to, but because bond prices hitting the floor shrinks their capital cushions. When banks lose money on their safe assets, they lend less. Small businesses feel it first, consumers feel it next. Small cracks turn into systemic tightening. And all of this happens before the public sees a single headline reading, crisis. Because repricing isn't dramatic, it's invisible. It feels like everything is more expensive. Loans are harder to get. Jobs are disappearing. Houses aren't selling. Projects keep getting delayed. And most people never connect the dots. All of it started with the bond market. There hasn't been a global repricing event like this since the 1970s, the decade when yields exploded, inflation surged, governments lost control, and economies were forced into painful resets. Back then, the repricing ended in stagflation, recession, and political upheaval. Today, the stakes are much higher. The debt loads are bigger. The leverage is deeper. The system is more interconnected. The safety margins are thinner. History shows there are only two outcomes once the bond market forces the world to reprice: a recession or a collapse. One is painful, the other is transformational. And the direction we're heading now, the signs, the data, the velocity, all point to a path that central banks fear more than anything else. Because what's happening next won't be a slow repricing. It will be a trap, one that central banks cannot escape. There is a point in every financial unraveling when the most powerful institutions in the world, the central banks, stop looking like pilots and start looking like passengers. That is the point we have now reached. And it's the reason 2025 feels so different from 1994. Because in 1994, the Federal Reserve had something priceless: room. Room to raise, room to cut, room to stabilize, room to make mistakes. Today, they have none. Inflation may no longer be exploding, but it's sticky. Too high to ignore, too low to panic over, but perfectly positioned to trap policymakers. Debt, meanwhile, is at levels that would have been unthinkable 3 decades ago. The government cannot afford higher rates, but it also cannot survive the consequences of lowering them. This is the central bank trap. Every possible move makes the crisis worse, just in different ways. If the Fed raises rates now, yields, already spiking, will surge even higher. That would accelerate the bond rout, push banks deeper into losses, trigger more margin calls, and send the global credit system into cardiac arrest. It would be a controlled demolition of the Treasury market. If the Fed cuts rates, inflation would ignite again. Prices would spike, the dollar would weaken, and the world would see what policymakers fear most: proof that the central bank is cutting because the system is breaking, not because the economy is improving. That kind of panic feeds on itself. In a world drowning in debt, rate cuts aren't stimulative. They're a confession. If the Fed holds rates steady, the current dynamic continues, the slow, grinding destruction of the bond market. Sector by sector, institution by institution. The repricing doesn't stop. The forced selling doesn't stop. The deficits don't stop. The refinancing crisis doesn't stop. It simply drags on longer, inflicting more pain. Raise, cut, hold. 3 choices, 3 disasters. That's what a trap looks like. But here's the part the public never sees. Central banks are already intervening. Not loudly, not officially, not in the dramatic emergency meeting fashion the public associates with crises. No, this is the quiet phase, the stealth phase, the phase where central banks pretend nothing is wrong while deploying tools normally reserved for panic. Emergency repo operations, backdoor liquidity windows, expanded swap lines, synthetic QE programs disguised as market functioning measures. They refer to these interventions with sterile language. Technical adjustments, liquidity fine-tuning, temporary support. But whenever you hear those phrases, understand something very clearly. Markets are seizing up, and the central bank is trying to stop the bleeding without announcing the wound. Most people don't know this, but these tools are the financial equivalent of CPR. They only appear when something vital has stopped functioning. Repo markets don't need emergency injections unless institutions can't find collateral. Swap lines don't expand unless foreign banks are starving for dollar liquidity. Technical operations aren't technical. They're red flags disguised as routine maintenance. And in early 2025, we saw all of them, quietly, briefly, and with a kind of anxious frequency that revealed far more than officials intended. Central banks are now supporting the bond market the same way they supported failing banks in 2008, not openly, but structurally. They are absorbing liquidity stress, suppressing volatility, and preventing auctions from going off the rails. But here's the uncomfortable truth. If the world's largest financial market, the U.S. Treasury market, needs secret support, it means the market itself is losing control. When the bond market loses control, central banks are no longer setting prices. They are chasing them. They become reactive, not proactive. They become stabilizers, not leaders. And once they enter that defensive posture, history becomes frighteningly predictable. Because every time central banks have lost control of the bond market, the crisis that follows becomes unstoppable. In the 1970s, it ended in stagflation and a brutal rate shock. In 2008, it ended in a global meltdown and unprecedented monetary expansion. In 2011, Europe's bond markets broke and entire governments fell. But the difference now, the terrifying difference, is that the scale is far larger. The debt is far bigger. The fragility is far deeper. And the tools central banks once relied on have been dulled by overuse. When the Fed buys bonds today, it triggers inflation. When the Fed sells bonds today, it triggers collapse. When the Fed pauses today, the system decays in slow motion. There is no version of this where they navigate smoothly. The trap is too tight. And this brings us to the next phase, the part of the story almost nobody studies, because it stretches beyond individual policy errors and into the long, repeating cycles of history. Because bond panics don't just cause recessions. They reveal the structural weaknesses of entire empires, and the pattern we're re-entering now is one the world has seen many times before, in the final chapters of financial eras. History doesn't repeat, but when it comes to debt, it rhymes with terrifying precision. And the deeper you dig into financial history, the clearer the pattern becomes. Every major economic reset in the past 2 centuries began with a bond panic, a sudden surge in yields that signaled not just market stress, but the unraveling of entire eras. Most people never look this far back. They assume today's world is too advanced, too engineered, too managed to suffer the same fate as past economies. But the bond market doesn't care about modernity. It responds to one thing: structural weakness. And when that weakness becomes systemic, yields rise violently, liquidity disappears, and history begins its familiar cycle. The first clear warning came in 1837. America was young, ambitious, and drowning in easy credit. States borrowed aggressively. Land speculation soared. Interest rates rose. Foreign investors pulled back. And then yields spiked, triggering a liquidation that collapsed banks across the country. It was the first major U.S. bond panic, and it reshaped the entire decade. Then came 1873, the Long Depression. Railroads had borrowed massively, assuming endless growth. When credit tightened and yields rose, railroad bonds began to fail, liquidity dried up, banks folded, entire industries collapsed. The panic lasted years, not weeks, and it set the tone for an era of deflation and stagnation. Fast forward to 1920. World War I had left governments with enormous debts. Central banks tried to normalize rates. Yields surged. Deflation hit like a hammer. Businesses failed. Farmers collapsed. And the stage was set for the Great Depression a decade later. Then 1973, the modern parallel everyone forgets. Inflation exploded. Oil prices soared. Yields spiked almost vertically. Governments panicked. The dollar suffered its greatest crisis since its creation. Bond markets rejected the low yields of the past and repriced the entire global financial system. That repricing wasn't gentle. It was violent, decade-long, and transformative. Even 1994, considered small by historical standards, was a bond panic. A sudden yield spike vaporized trillions, broke hedge funds, and nearly destabilized global credit. But compared to today, 1994 was a controlled burn. Then came 2008, when subprime losses triggered the largest bond liquidation since World War II. Yields didn't just rise. Credit markets froze outright. Entire nations teetered. Central banks intervened on a scale previously unimaginable. And now, 2025. Look at the pattern. Rising debt, rising rates, liquidity squeeze, forced selling, economic contraction. This is the architecture of every bond panic in history, and today, every single condition is back, amplified. Debt is higher than any previous era. Rates jumped faster than in 1994. Liquidity is thinner than in 2008. Government deficits are larger than in 1973. And the system is more leveraged than in 1873. These aren't coincidences, they are signals. Empires never fall through their armies, they fall through their bond markets. The Roman Empire didn't collapse because of military defeat. It collapsed because its currency and credit system decayed under compounding debt and debasement. The British Empire didn't lose global dominance because its navy weakened. It drowned in war debt that drained its fiscal capacity for decades. And now, the American system, built on the U.S. Treasury as the risk-free foundation of global finance, is showing the same stress patterns. The data is not subtle. It's glaring, it's historic, and it's accelerating. Bond panics are rare. They are destructive. They mark the turning points of entire civilizations. But what makes the current moment so dangerous is not just the similarity to the past. It's the speed. Historically, these cycles unfolded over years. Today, they unfold in weeks. Digital markets move faster, derivatives amplify pressure, global leverage magnifies shocks, and the yield surge we are witnessing now is happening at a pace unmatched by any historical panic. The cycle is reaching its breaking point. The pressure is building. The next stage will not be gradual, it will be violent. And the consequences of what happens next extend far beyond markets. Because when a bond panic reaches terminal velocity, it doesn't just hit investors, it hits everyone. The question now becomes, what happens to society when a bond rout becomes unavoidable, unmaskable, and unstoppable? The next chapter reveals the consequences most people are not prepared for, but should be. When a bond market breaks, it doesn't look like an explosion. It looks like a slow, almost invisible unraveling, threads snapping one by one until the entire fabric tears. And if the current bond rout continues, the consequences won't resemble anything modern societies have ever lived through. Not 2008, not 2000, not even the stagflation of the 1970s. What's coming is deeper, more structural, and far more personal. Because this time, the crisis won't start in the stock market. It will start in the plumbing of the financial system, the credit markets, the parts no one sees until it's already too late. And right now, that plumbing is cracking. The first and most immediate blow will hit governments. As yields continue rising, financing costs become impossible. Interest payments begin devouring national budgets. Money that once funded schools, infrastructure, healthcare, and social programs is suddenly redirected toward one thing: paying bondholders. It's fiscal triage, and governments will respond the way they always do when cornered, by cutting the very services that citizens rely on. Pensions trimmed, benefits reduced, projects cancelled, subsidies withdrawn. Not because politicians want austerity, but because the math leaves no alternatives. Austerity isn't a policy choice in a bond rout. It's a survival mechanism. Then, the shock hits banks. Banks are supposedly safe because they hold risk-free treasuries. But when risk-free assets collapse in price, the entire banking system begins bleeding from the inside out. Capital ratios fall, balance sheets shrink, regulators quietly step in, lending standards tighten, lines of credit vanish. Small businesses feel it first. We can't lend right now. Try again in 6 months. Families feel it next. Your mortgage approval expired. You'll need to reapply at the higher rate. Larger corporations feel it last, but when they do, the damage is brutal. Debt can't be refinanced. Cash runs short. Layoffs ripple through industries, defaults rise, and the public sees none of this until after the layoffs hit the news. Next comes the currency. As bond markets seize and financing becomes unstable, confidence begins to erode. Investors start questioning whether governments can sustain their debt. The dollar, or any national currency, begins to wobble. It doesn't collapse outright, but it weakens, loses purchasing power, drifts into a state where inflation becomes sticky and unpredictable. People notice this, not through charts, but through grocery bills. The price of living rises faster than income. Savings begin to shrink in real terms. Retirement portfolios, heavily weighted toward bonds, bleed quietly. The safe portion of people's savings is no longer safe. Millions will experience this as a psychological shock. How can my retirement be falling when the market isn't crashing? Because crises don't begin with stocks plunging. They begin with credit tightening, and credit is already collapsing. Then the social contract begins to strain. A society built on cheap credit cannot easily adapt to expensive credit. Home ownership becomes unreachable. Education financing becomes oppressive. Business creation stalls. Wealth gaps widen. Social tension grows. The political center collapses as people drift toward extremes promising easy solutions. The bond market is not just a financial mechanism. It is the foundation of the modern social order. And when the foundation cracks, everything built on top of it starts to tilt. But the most dangerous part is the snap. Bond crises don't destroy societies slowly. They weaken them slowly. Until one day, something breaks suddenly. A failed auction, a major bank collapse, a sovereign unable to refinance, a currency shock, a liquidity freeze. One event, the spark, ignites the accumulated pressure. That is when the route turns from crisis to restructuring. Not a recession, not a correction. A full-scale restructuring of government spending, debt obligations, monetary policy, social expectations, and even the financial order itself. It means new rules, new priorities, new sacrifices, new winners, and many new losers. The question isn't if this restructuring arrives, it is when. And the events of 2025 are accelerating that timeline at a speed no one expected. Because every bond rout in history ends the same way, with a reset. And that reset, the one waiting just beyond the horizon, is already starting to take shape. When a bond rout reaches its final stage, it stops behaving like a market event and starts behaving like a reset, a structural transformation of the entire system. And every major bond panic in history has ended this way, not with equilibrium, not with a return to normal, but with a forced transition into a new financial regime. That's where we are now. The signs aren't subtle, they're not hidden, they're not theoretical, they're happening in real time, quietly, steadily, and with a kind of inevitability that only becomes obvious in hindsight. Because once a government loses control of its borrowing costs, the reset is no longer optional. It's mandatory. The first tool in that reset is financial repression. A phrase that sounds academic but simply means this. The system will protect itself at the public's expense. Governments will push yields down artificially, not through economic strength, but through policy brute force. They will cap long-term rates, they will intervene in auctions, they will pressure banks and pensions to buy government debt. They will use regulations to trap capital where they need it most. This isn't speculation, it's the historical playbook. In the 1940s, the US capped yields for nearly a decade to pay off war debt. In the 1970s, Europe forced banks to hold government bonds. Japan has been doing it for years through yield curve control. When debt grows too large, the free market is removed from the equation. Governments don't ask buyers to support their debt, they compel them. And that compulsion always starts with institutions, but it never ends there. Then comes higher taxes, on corporations, on capital gains, on wealth, on inheritance. Not because politicians prefer taxation, but because collapsing bond markets leave them no other revenue stream. When interest costs devour budgets, governments claw back money wherever they can find it. After that comes currency erosion, the quiet tax. The kind people don't notice until after the damage is done. Inflation, once dismissed as a temporary nuisance, becomes a strategic tool. Not runaway inflation, but controlled erosion. Just enough to shrink the real value of government debt over time. A dollar that buys less is a burden on citizens, but a blessing to a government drowning in obligations. This is the mechanics of reset. Make debt cheap, make savings weaker, make capital flow where the state needs it. In severe cases, resets go further. Some nations enforce capital controls. Others freeze pension contributions. Some restructure their debt outright. Others default internally through mandatory conversions or special levies. Defaults don't always look like fireworks and headlines. Sometimes they look like a forced bond purchase, sometimes like a pension haircut, sometimes like temporary emergency measures that never get reversed. This is the uncomfortable truth. When a system this large begins failing, it doesn't implode. It reshapes itself around the weakest participants. And the weakest participants are almost never the banks or the hedge funds. It's the public. But resets aren't only destructive. They are also transformative. Every major reset in history has birthed a new financial order. The Panic of 1837 reshaped American banking. The crisis of 1873 sparked industrial consolidation. The 1920s restructuring gave rise to modern central banking. The 1970s reset created the petrodollar system. The 2008 reset generated an era of massive liquidity and asset inflation. Resets don't just end cycles, they forge new ones. Markets shift, power shifts, wealth shifts. Entire industries disappear while new ones explode out of nowhere. In moments like these, the people who understand what bonds actually represent, claims on future government capacity, are the ones who adapt early. They see where capital is forced next, they see where policy is steering the river. They see the new incentives shaping the next era. Those who don't understand it, they get blindsided, they freeze. They become the liquidity that the system extracts from. Because the final shock, the one almost no one sees, is this. The reset isn't coming. It has already begun. Governments have already shifted issuance to short-term bills. Central banks have already intervened covertly. Bond markets have already repriced global valuations. Deficits have already surpassed sustainable levels. And yields have already broken their historical constraints. We aren't waiting for the reset. We're living inside it. And the world that emerges on the other side will look nothing like the world that entered it.